Hi everybody, Matt Watts with Icon Mortgage here, or as a lot of people refer to me, Mortgage Matt. Today I want to talk to you about conventional loans, to explain a little bit about them, why you may choose it or may not. A conventional mortgage is just a mortgage that isn't relying on a government program for its underwriting or for its insurance policy. So whereas if you were to get a rural development loan, we actually are using the USDA to issue the lender an insurance policy that basically if you don't pay the lender back, the lender can make a claim against that insurance policy. When you hear conventional mortgage, it's going to be one of two types of mortgages, either a Fannie Mae loan or a Freddie Mac loan. So Fannie Mae and Freddie Mac set a underwriting structure that will guarantee that your loan meets certain quality standards. That way the loan is easier for your lender to sell on the secondary market, and most mortgage lenders, that's how they make their money. In fact, conventional loans actually comprise a very wide array of mortgage products. And I mean all the way down to 620 credit scores, all the way up to the best credit score you can have. All the way from as little as zero down payment with certain down payment assistance programs to 1%, 3%, 5%, and on up. One of the main advantages of a conventional loan versus FHA or rural development is that if you do have really good credit and a really good qualifying situation, you are likely to actually feel the benefits of that. For a conventional loan, everything about you will comprise a pricing profile that will dictate your interest rate and your mortgage insurance. So a lot of times people with conventional loans spend a lot of time and a lot of effort trying very hard to shop around various lenders for the interest rate and completely forget about the massive difference that mortgage insurance can cause and forget to shop around for that. So it's just as important to have a lender that offers you a good interest rate based on your loan terms, but also has access to some of the best mortgage insurance rates. Another big benefit to a conventional loan is PMI. And I know that's going to sound funny because PMI has a bad reputation out in the world. However, that's because most people don't really understand its function or how it helps them. So on a conventional loan, your lender will have the opportunity to shop around through a few different companies to hopefully get you the best deal possible on your mortgage insurance. And with private mortgage insurance, it generally will only last until you have 20% equity in your home. So once you've reached that equity marker, your mortgage insurance should either automatically drop off or you'll have the ability to challenge your mortgage insurance to get it dropped off. Now, there are a whole lot of nuances with that, so it'll require a separate video to explain when you can get rid of mortgage insurance and how to do it and all that. That's forthcoming. In most cases, government-backed loans have mortgage insurance that will stay the same for the entirety of the loan, or at least will take longer to drop off than with PMI. Now, without a doubt, the greatest advantage to a conventional mortgage is one that really is not even true, which is the perception of conventional loans in the real estate marketplace. So ultimately, it doesn't matter whether it's correct or incorrect. That is, in fact, the prevailing attitude of the real estate market, is that conventional borrowers are stronger borrowers than an FHA or rural development loan. That means that you are going to have more negotiating power when you go out to make your offer. And in particular, in the last few years here, since 2020 and now on in through 2024, and likely to continue, when we are in a tough market for buyers like we are right now, chances are you're going to have to do anything you can to strive to get a conventional loan because it will put you a head above all of your competition. The good news about that is there are in fact more options for a conventional loan than ever. And in fact, right now we've seen more and more expansion of what Fannie and Freddie call the community lending products. So for Fannie Mae, this is called the Home Ready loan, and for Freddie Mac, called the Home Possible loan. Although Freddie Mac has about 7 different variations of that also offer various opportunities, but most of them are about the same. Ultimately, it means that you can get in with 3% down. They've expanded the types of credit that they'll approve, so you're more likely to get approved for the loan with a more tumultuous credit history. They also have greatly limited the amount of upcharge that a lender can charge you for getting a loan based on your credit profile. So whereas if you were a 660 credit score, let's say, you generally would be driven to an FHA loan based on price alone, because FHA doesn't upcharge for having a lower credit score, whereas conventional, everything about your credit profile dictates your price, and therefore a 660 may end up paying so much more than your average 750 borrower that it would simply price them out of being able to afford the home in the first place. And that not only goes for the interest rate, but again, the mortgage insurance. Well, in the case of community lending, this actually is limited on both ends. So not only can the lender only upcharge you so much for having a lower credit score, but the mortgage insurance company as well. Now, one of the places that will really separate whether or not you're able to get a conventional loan or you have to go back to a government loan is how much money you'll have available, not only just for the down payment, but also for the closing costs and the escrow setup. Because one other thing that is a little bit more constringent with a conventional loan is that they will only allow you to use 3% of whatever your sales price is in seller's concessions. Now, in a lot of markets these days, seller's concessions are just not a reality anyways. But let's go ahead and cover that difference just in case you happen to have that availability. So this will really make a difference in lower loan amounts. So let's just say a $100,000 home. Well, if you were to buy that on an FHA loan and you really had very, very little money out of pocket, not only do you have just the 3.5% down payment, but you would be able to get 6% in seller's concessions from the seller to help you pay your closing costs. Well, on a $100,000 loan, that should just about cover most of your costs that you have for the loan. However, with a conventional loan, they limit you to only 3% of the purchase price. So you've cut that in half. And on a $100,000 loan amount, chances are that might be enough to cover your closing costs, but not the escrow setup, which is also generally the more expensive part. So in that case, if you really have only the bare minimum out of pocket available, you may be forced to go with an FHA or a rural development loan. So hopefully that explains a little bit about conventional loans and if they may or may not be the right thing for you. If you have more questions, you can reach out to me anytime at 810-919-8138, or just hit the Apply Now button in my menu and we can take a look and see what would be the best option for you, whether that's conventional or otherwise. Thanks.